A third stock valuation method is the free cash flow method. Many companies do not pay dividends and have not paid dividends for long periods of time. For example, Microsoft didn't begin paying dividends until 30 years after its initial public offering, so somewhere around 2000 began paying a dividend. Another example of a company for long periods of time that's not paying a dividend is Berkshire Hathaway. They have never paid a dividend. The free cash flow method helps us to value stocks that don't pay dividends, and perhaps we don't foresee them paying dividends anytime in the near future. So under the free cash flow valuation model, we first determine the value of the entire company as the present value of its expected free cash flows discounted at the firm's weighted average cost of capital. And that gives us a value, VC, for the entire company. So we're simply discounting these free cash flows at the firm's weighted average cost of capital to arrive at the value of the entire company. Because we're valuing the entire company, we're going to pick up the market value of other assets. So we're going to pick up the market value of the firm's debt, and we're going to pick up the market value of the firm's preferred stock. So to calculate the market value of the firm's equity, we need to take the market value of the entire company and subtract the market value of debt and the market value of preferred stock. So let's take a look. This example is in your textbook. Dewhurst Company wishes to determine the value of its stock by using the free cash flow valuation method. So we've got the following data. So we got for several years we have some free cash flows, and then we believe that after year 2020 we're going to have a long-term constant growth rate in free cash flows of 3%. We have a weighted average cost of capital of 9%. The market value of our company's debt is $3.1 million. The market value of the company's preferred stock is $800,000, and we have 300,000 shares outstanding. So let's look at the Dewhurst Company in a spreadsheet. So the Dewhurst Company, we have a required rate of return. Our weighted average cost of capital is 9%. We don't have a fixed variable growth rate in the free cash flows, but instead we have actual estimates of the free cash flows, so we don't have to worry about the variable growth rate percentage. And then we have a long-term growth rate after year 2020 of 3%. So using the data provided, we have the free cash flows from 2016 to 2020, and after year 2020, so in year 2021 and beyond to infinity, we have this 3% long-term growth rate in dividends. So we're able to calculate a free cash flow estimate for 2021 as simply our estimate for the year 2020, a free cash flow of $600,000 multiplied by 1.03, or increased by 3% to $618,000. We can then apply our constant growth rate formula, and instead of using dividends, use free cash flow to calculate the present value of all those future free cash flows in the constant growth rate period, and that works out to be $10.3 million. So again, you can kind of look at the cell here. We're just applying that constant growth rate formula where we're taking the $618,000 divided by the difference between our required rate of return of 9% and our 3% long-term constant growth rate. That yields us $10.3 million. So the total cash flows, so we have our total free cash flows for each period from year 2016 to 2020. So in 2016 through 2019, these are simply the free cash flows. And then in year 2020, we've got the sum of the free cash flow of $600,000 and the present value of all those future free cash flows in our constant growth rate period of $10.3 million. So our total free cash flow in year 2020 is $10,900,000. And then we can calculate the present value of each one of those cash flows just using our simple present value discount formula and then summing them up. Or we could just directly use the NPV formula, so the net present value formula in Excel, to come up with the same $8,628,000. So the entire value of the firm then is $8,628,000, and then we're going to subtract the market value of debt and then also subtract the market value of preferred stock. So that gives us a market value of equity of about 4.7 million. And we have 300,000 shares outstanding. So the market value of equity divided by the number of shares outstanding gives us a price per share of $15.76.